show me a life insurance, a whole life policy.
Yeah.
What you're going to see is you're putting in, premium. Let's just say it's $100,000 a year you're putting in. You'll put $100,000 in year one and you'll have zero in your cash value.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, I'm excited to welcome Blake Brogan and Rod Zabriskie of Money Insights. And we're going to talk about why I first started my life insurance policies over 16 years ago, and whether it makes sense for you and how you can use properly structured life insurance to pay for things like college, emergencies like I faced during Helene, COVID, and other times during my life and my business. You can also structure them in conjunction with your investments to get a higher rate of return. We're going to dive into all those topics on today's show. Blake, Rod, welcome back to the show.
Hey, thanks, Chris.
Yeah. Gentlemen, we have, you guys are part of our regular guest rotation, which is a rare group. But for those of us that don't know, I've been working with Money Insights for, it's been almost 5 years, right, Rod?
I would say at least. I was thinking, maybe 5, 6.
Yeah. So for those that don't know the story, I want to share a little bit about, my story with through the life insurance journey. And I talk about this in my book, but for our newer listeners, I started our policies actually 16 years ago now, Rod, my older son. This is going to air on March 10th, and my son turned 16 on March 7th. So we're a little bit before that today. But yeah, so when I found out my wife was born, the first thing I thought was, can we still do our trip to Europe next year? And the second thing was, oh my gosh, what am I going to do for college? What am I going to put in place to protect my family if something happens to me, happened to my father? And through my journey, I came upon overfunded cash value whole life insurance. And those were the policies that we originally started with the intent to, have a guaranteed, and we can't say that in the investment world, but we can say that in the insurance world, a guaranteed pool of capital for my son to have access to when he got to college. And, as important, it also was, if something did happen to me, that money would be there for him as well through the insurance component. But what led me to you, Rod, and Money Insights and your partner, Christian, over 5 years ago, was that we started using our policies, and more specifically the cash value of our policies, to build spec homes and then invest. And when I talked about it with my agent at the time, he was kind of surprised, but he knew about using these things. And he said, Chris, I wish more people use their policies like you do. This is awesome. And I remember hanging up, and I was like, now, to be fair, this gentleman is in his 80s. He's kind of winding down his practice. But I was really frustrated. I said, well, why didn't he tell me about these things? So I went in search of resources that could help me get more use out of my policies. And that's what led me to you guys, Rod. So I'd love for you to share a little bit more behind, why you founded Money Insights. And Blake, love for you to share, before he does that, a little bit about your background as well, because we do a lot of work together, and when you joined Money Insights as well.
Yeah, so I joined Money Insights 4 or 5 years ago, but high cash value life insurance has been my entire career up until this point. So I was fortunate. My parent, or my dad, my uncles, my grandfather were all in the insurance space, at some, during their careers, doing different things there. I actually learned about these high cash value life insurance strategies while I was in college. Professor of mine had told us about how he used this to fund businesses that he was doing. And then a fraternity brother of mine said, hey, my family's been doing that for a long time. They tried to explain it to me. It didn't make sense. I didn't have any money, at the time in college. But as I was getting out of college, I was, I knew I wanted to be in business and do entrepreneurship. I went to school to study entrepreneurship. And I said, I want to put my savings in a place where I am going to have access to it, have liquidity. It's going to be there, just like all the things you mentioned, Chris. When your son's born, you're starting to think about, how am I going to protect my family? So for me, it was just a great place personally to start saving money. I got connected to some business owners locally. So kind of got me going, helping people with the strategy. And then, been blessed to be part of Money Insights for the last 4 or 5 years, work with a lot of people from your audience, Chris. And really my role is that client interaction. So prospective clients, current clients, having conversations, helping them set up the policies. But what I enjoy even more are meeting with our clients on a regular basis to continue to see how their world's evolving, see how the policy can help them facilitate the different things they're doing in investments. So frankly, it's a dream fit for me.
Oh, it's a dream fit for us too, Blake. You're awesome at what you do, helping our clients, and more specifically our investors that are looking to structure these policies to really optimize their investments and what they're doing. And Rod, how many people do you know? I mean, Blake is like 101 in my world that in college was looking at these strategies with life. I mean, when did you start your first policy, Blake? Weren't you already?
Yeah, I was 23, 24, right after, as soon as I started making money.
Incredible.
Yeah, that's awesome, and a great story. And as far as on my side, Chris, I'll give a little about history on our side, and then when we met up and kind of what we've seen with you, I just again, it's second to none. So you're asking how Christian and I got started in doing what we're doing.
Yeah.
So we actually come from a life insurance background as well. I actually started in the industry in health insurance. Once Obamacare was passed, I was like, okay, the writing's on the wall. I gotta do something different here.
Yeah.
So got involved in life insurance, and I think I bring that up because I think it's a little bit unique. A lot of people who are involved in this space come in from other directions, which isn't bad.
Yeah.
But I think what it allows us to do is to always be on top of building the policies in the right way. And I think we'll talk a little more about that, the reason why that's so important here in a little bit. But so, I was more of like, you might say, a generalist inside the life insurance world, just helping people, anybody that needed life insurance for whatever purpose, across the spectrum of, basic term to protect our families to, meeting with businesses who are doing more advanced kind of planning and different things that involved life insurance with buy-sell agreements or key person policies or all these different things. Well, then we got working with and really my background is in entrepreneurship. I have an MBA in entrepreneurship, and so I've always just had a love for people who are out there living the American dream, doing really cool things, building businesses, and investing. And so you bring those two together, rich dad, poor dad, just all the different kind of background things all coming together, and using the investment optimizer, life insurance policy in conjunction with that investing has just become a real core piece to what I do. And Christian and I both in the way that we invest, and then just helping other people. Once they catch that vision, they're like, oh man, this is amazing compared with the alternative. And so just, doing what you're doing. And so now kind of, I want to brag on you a little bit, is when we met you, you were still doing your job.
Yeah.
Traveling, doing the sales, but you had the dream, right? The dream of having enough free cash flow that you could replace your regular income, and then just everything's on your own terms.
Yeah.
And so it's just really cool to watch that process. And we were towards the latter end, right? You'd done a lot of amazing things before that, especially, for you going back to your days in college and already starting to invest in real estate and all those things.
Yeah. Well, thank you.
But it's amazing to watch you make that transition from a place where you were already a high income earner doing really cool things in the medical device space. But the things that you've done since then, it's just amazing. Like even as amazing as things were, it's still night and day difference you are doing and have been able to do since then. So it's been really cool to watch.
Well, thank you for that. And yeah, I think, what's neat about this strategy with life insurance, Rod, is that it works. It can fill so many roles. Like, I just wanted a guaranteed pool of capital for my son, and then ultimately sons, to have access to for college and give them security. And then we started using it. We built spec homes. I think it's really great for, people like myself at the time that are, high income earners, but variable income, sales. I mean, I was full commission. So, I had really lean months, I had really amazing months and quarters. And, the neat thing about these policies is, you can fund them and really, as I became a 1099 employee and then had my own business, you really have your own personal pension. You have like a guaranteed income stream in the future. So, you can have, guaranteed pools of capital, you can have guaranteed income streams for the future. And then as we've done now, as we've started to really optimize and build these policies, for myself, for other investors, so that they can actually have greater returns on their investments. But I want to, underscore why we ultimately partner with you guys, Rod, is all the different agents that I talked to. They all said, "Oh, we'll convert your policies, do this, we can bring." And you guys said, "You know what, Chris, you have good policies. Let me just help you optimize what you're doing." You guys didn't try to sell me on anything. You're really education forward, which is a good fit for what we do. When COVID came along, I had some spare time on my hands that allowed me to get licensed. And, what happened was a lot of my investors were asking me, "What do you do? Like, how do you structure your personal finances and ultimately your investments?" So I was telling people about this strategy, and it was great because now I can put them in touch with you all, and we can do this together. Rob, when I first learned about this strategy, I heard it on the radio. It was called Bank on Yourself. And then I started digging and learning more. And I read Becoming Your Own Banker by Nelson Nash and, IBC's or infinite banking, concept. Can you just describe how these policies, these, the investment optimizer or IBC or Bank on Yourself, how these policies are different than a traditional whole life insurance policy?
Sure. Yeah. And so let's start with the traditional. So, and what that means is if you just went off the street and into any life insurance, business and said, "Hey, show me a life insurance, a whole life policy,"
Yeah.
what you're going to see is you're putting in, premium. Let's just say it's $100,000 a year you're putting in. You'll put $100,000 in year one and you'll have zero in your cash value. It's just all gone to cost. Okay, cost of insurance, administrative costs, what the agent got paid. And year two, you put another 100,000 in, and depending on the company, you may still not have anything in your cash value. Really, it's beginning in year three to where you really start to see something growing in cash value. And then if you play that forward and say, okay, well, there is some growth, right? So once you now start having money in your cash value, it's growing and earning interest and dividends. Well, your break-even point to when you get to the place where you're going to have as much money in your cash value as what you've put in doesn't happen until year 13, 14, again, depending on the company and the policy. So in my example, you've put in $1.3 million and you finally in year 13 have $1.3 million in your cash value, right?
Right.
So can there be situations where that's attractive? Maybe. I'll let you know what we're doing and why I think there's no I would ever want to do that.
Yeah.
Because when you design it in the way that we're doing, and specifically what we're doing is we're trying to minimize the cost, keep them as low as possible, so as much as going in that policy lands in your cash value and is usable to go out and use for your investing or other purposes, right? Whatever you want to use it for. So when you put that first 100,000 in, 80% of that is landing in your cash value. Okay, so you have 80,000 in your cash value. You can start using that as soon as 30 days later. And then in year two, you put your next 100,000 in, and 90% of that lands in. And by year three, the costs are so low, and now you have that growth that's already in your account that's earning for you, so that by year three and forward, it's net positive. You put 100,000 in, and you're going to see more than $100,000 of increase on your cash value, and that just continues to compound and grow to the point where your break-even point is going to be more like year 5 or 6 in the way that we're doing. But again, you don't have to wait that long to start using it. You can start using that money immediately for what is there.
Yeah. No, and I love it. And it's, we were at a meeting last week out in Salt Lake City, one of my favorite of the year, because I get to see you guys, I get to ski. The content's great too. Got to speak on stage. That was fun. But fun. It's always the partnerships, and it spurred a lot of conversations. You guys had a booth out there, and one of the topics that came up was like, well, is this like a family bank? And it's interesting because a lot of people, that are not just high income earners, but are really, really wealthy, Rod and Blake, they're using these to literally build their own bank for themselves, for their families, to go forward. And Blake, in my MBA studying finance, it was like, oh, I did portfolio management, so it was learning how to manage and invest money. And what I learned was, hey, buy term, invest the difference. And I'm like, I'm learning that really financial advisors are just salespeople. And I found out the same on the insurance side. It's like, wait a minute, this is not what the ultra wealthy are doing. Blake, 100 years ago, whole life insurance was the standard. What happened with term life insurance and investments, and why did really, specifically the U.S. kind of get away, the population as a whole, from using whole life?
Yeah, I think as I mentioned, like my grandfather, who was born in the 30s,
Yeah.
he was in the life insurance space, early in his career. And I remember him telling me stories like he would go to fraternities, knock on the door, and like sell small whole life insurance policies to all the fraternity brothers, and then he'd go to the next. Like that was his kind of target market.
Wow.
But he's like, everybody saved money in life insurance. Like it was like
Yeah.
completely normal. That was just kind of par for the course. Oh, great guy.
Yeah.
Obviously everything was in person there. There's no electronic communication or anything back then. But really, Wall Street, from my understanding, just started to pick up, especially with mutual funds and retirement accounts and 401ks, and just a lot of money started shifting into the market. And so if you have this idea, the market and the accumulation of wealth, meaning, in real estate, we're investing for a lot of reasons, but cash flow being a big piece of that. If you're all into the market, you're saying, hey, I'm going to take some of my earnings, I'm going to put it aside, I'm going to let this thing grow for 30, 40, 50 years, and then hope there's enough there for me to be able to sit down in retirement. And so where I think the term came in is they say, hey, this whole life insurance, quote unquote, costs a lot more. You're paying more premium dollars, same death benefit, where what we could do is just get a cheaper term policy where there's less premiums, you still protect your family. And then the idea is you're self-insured by the retirement and you don't need this life insurance. And, if all you're doing is accumulating money in the stock market, potentially that strategy might have some play. However, as people get older, they think, hey, I'm not going to need insurance when I'm 60, 65 years old. In reality, the people that we're talking to, they're the ones who are always saying, these are very wealthy individuals. They may be worth 10 million bucks. And they're like, man, I wish I would have bought so much more of this when I was younger and it was less expensive, because I have this need for a permanent benefit, whether it be for estate taxes or to more efficiently pass my wealth on to the next generation, or for charities, or protect all the debt that I still have, even though I've accumulated a lot of wealth. And so really, when you're thinking about the policy, it's not an and or. I have a lot of term insurance myself, but it's getting to, in my opinion, the root of life insurance, which is a place to very safely store your capital, know that you're going to have it grow in a tax advantage way, but give you liquidity to then go out and invest in deals that you're offering and other type of cash flowing assets.
Yeah, and I love that. You say it's not, you said it's not and or with term and whole, but that's the cool thing. It's not and or to build a policy like our investment optimizer policies, or invest. So Blake, can you talk about kind of the core structure of how an investment optimizer whole life insurance policy is different than the policies that Rod was talking about?
Yeah, for sure.
Like you put a $1,000 or $100,000 into a policy, you got zero cash value.
Yeah. So when we're having conversations, if you think about any type of insurance, homeowners or typical life insurance, auto insurance, basically the conversation is how much protection do you need, and what's the least amount of premium that I can pay, for this. Where we're taking a completely
cheapest option out there. That's
cheapest option,
as
shop it out.
Yeah.
Yeah. And that's why you see a bunch of companies saying, you get letters in the mail, every day saying, hey, switch and save type of thing.
Yeah.
When we're having these conversations around the investment optimizer, we're doing it in the opposite direction. So when someone understands the principles of the strategy, how it can increase their returns, give them the safe pool of capital to then borrow against and go out and invest, like all the things that we've been talking about, what we're starting with is, generally speaking, that the goal is to be able to get any dollar that's essentially going to go into a syndication or into a cash flowing asset through the policy first. So we're going to build the policies more around your investing strategy. And then from there, we're going to reverse engineer to the policy to say, what's the least amount of insurance? And the reason we want a low amount of insurance is we're trying to minimize the cost. Again, our focus here is all in the cash value. So insurance is important. We have it. Sometimes that's why we might get a term insurance policy on top of that to make sure all of that's taken care of. But the investment optimizer side, we want high cash value, low cost of insurance. Okay. Now, once you have that built, as Rod mentioned, maybe 80% year one is landing in cash value as opposed to zero. So we have clients all the time who will fund a policy, and then, within a couple months when the next deal's coming around, that's where their capital's sitting, that can take a loan and go out and invest and have your money growing for you in two places at once. And the last thing I'm going to mention here, when we build it this way, and this kind of goes back to what you were talking, Chris, in your sales role, you might have a good quarter, you might have a bad quarter, you might crush it one month, you might, have a very weak month. That happens. We build in a lot of flexibility. So when someone thinks about whole life insurance, $100,000, man, am I committing to $100,000 every year for the rest of my life? Like, if I don't pay this, does the policy go away? The answer to that is absolutely not. We build in a lot of flexibility. We'll talk about this idea of a funding range, meaning if you want the ability to put up to 100,000, the insurance company is only requiring you to put in maybe 20 or 25,000 a year. And that's only really for the first 4 to 5, or depending on what your age, a maximum of 7 years that they're requiring you to put even a much lower amount than you would be able to. So for people who don't know what their income is going to look like, don't know when investments are going to kick off cash flow, these are incredibly powerful tools that allows you to store your money safely, but you're also not locking yourself into something. You have a ton of flexibility, and that's a lot different than kind of a standard whole life policy.
Yeah, and what I love, the policies that we built together, Blake, is, they're self-sustaining after 5, 6, 7 years, 10 years, maybe at the most. And I'm coming up on my 7th premium on some of the policies that we started. It's like, wow, I don't have to fund these ever again. And they're just growing from then on. One of the cool things, I got a phone call a few years ago, and my mutual friend of a friend of mine was selling a car wash. And he's like, hey, man, we can get a really good deal on this car wash. It was going to kick off and it has about 20% cash flow. He's like, but we need to close within 4 weeks, and it's going to be $500,000 between the two of us. And I had that cash value, that $250,000 accessible. And I mean, it was less than 24 hours that I can get that money. It was incredible to be able to do that. So it really gives you a place, as I talk about in chapter 3 of my book, like your opportunity fund is, as you talk about, Rod, and Christian, you guys have talked about for years, like where are you storing your money in between deals? And, a lot of people have this money, but it's just sitting in a checking account or maybe a, money market fund or something like that. What are the typical returns that an individual can see in these policies? I'd love to share, maybe some of the, the different structures or cool strategies that business owners or, doctors have used. I know you guys work with a ton of doctors that have creatively used these policies.
Yeah. So in the policy, we've talked about how they're pretty consistent in growing. Yeah. And there are basically two components that make growth. There's a guaranteed interest rate associated with your cash value, and then there's also a dividend that you earn. And the dividend comes because we're specifically using what are called mutual life insurance companies, which just means the policyholders are owners of the company. So when there's a dividend paid out, it goes directly back to the policyholders, and we just roll that back into the cash value and keep that growing.
Let's underscore that. I think this is really important because one of the reasons I originally invested with Vanguard is that they were a mutual company. And the difference between a mutual life insurance company and a public life insurance company is that the profit in a company that's owned by shareholders goes to the shareholders, whereas in a mutual life insurance company, that excess profit goes back to the policyholders.
Yep.
So that means that if you pay too much in terms of the cost that the life insurance company charges, it goes back into your pocket. And the company has to turn a profit to stay afloat. And, Penn Mutual that we do a lot of policies with, they've been in business for how long?
Since 1847.
Yeah. So they're doing,
they're doing
pretty
a dividend
good.
In 1849.
Yeah, they're doing pretty good. So you have the guaranteed interest rate, you have the dividend. What's that typical range look like? So for instance, what in 2026, what's Penn Mutual paying out?
Yeah, so they're paying a total of 6 between the guaranteed plus the dividend. And that's going to vary a little bit from company to company, but really they're all pretty consistently between right now 5.5 and maybe 6.25.
Yeah.
So it's And if you look over the past 20 years, so 10 years ago,
Yeah.
interest rates had been zero for already what, 6, 7 years. But they were still paying in that same range,
Yeah.
right? That
Yeah.
six-ish percent range.
Yeah.
And so does it adjust a bit based on interest rates? It does a little bit,
Yeah.
but it's just very, very consistent,
Yeah.
which makes a big difference in this context because if I'm putting the money in there, not to stay there, I'm not trying to make the policy the investment. I'm going to
Right.
loan against that and go out and invest in something else, knowing that the underlying asset and the cash value that's there acting as collateral for my loan is just going to do what it's going to do. I don't have to worry about it. It makes a huge difference.
Yeah. Yeah, and I think there's really three levels to use these policies. There's, hey, I'm going to put money into these policies. I'm just going to let it grow. I'm going to maybe use that money as guaranteed income in retirement at some point. There's, kind of the second level, which is the investment optimizer, whereas you're using these policies to fund and then ultimately borrow against. And people might be saying, well, Chris, like, why would you borrow $1? To invest $1. Why not just invest it? So I want you to dive into that. But the third is, using these policies as a generational wealth tool on top of that. So before we get to that, why would you want to put $1 into a policy to just turn around and borrow it back out to invest? How does that make sense?
Yeah. Yeah, it's a good question. And what's interesting is that cash value is there. It's your money. You could take it out as a withdrawal and go do something with it if you wanted to.
Yeah.
But in this case, the reason why we use loans is because when I do that, my money stays there and continues to grow.
So you're using the cash value as collateral, not removing
correct.
it.
Yep. Yep.
Yeah. Like the
So
equity in your house.
yeah, going back to the starting point, I've put money into the policy. Some of it, cost went and paid for the insurance part of it,
Yeah.
but most of it landed in the cash value where it's now growing on a consistent basis. Automatically from the insurance company, I have a line of credit available to me using that cash value as collateral. Up to 95% of what I have in my cash value, I can get access as a loan. So then I use that loan, I go out and invest it. I'm creating whatever kind of return I am out there. And in the money that's sitting there acting as collateral stays there and continues to grow as well.
Yeah.
So and so someone might say, okay, well, what about interest, right? Are they going to charge me interest? And the answer is yes.
Yeah.
You'll pay interest on the loan. But one thing that's really interesting is when you look at the flow, and I've invested, I'm creating some sort of cash flow coming back, and I'm using that to pay toward my loan. I end up paying simple interest on a decreasing value as I do that. So simple interest on the loan side, but the money that's acting as collateral is just staying in there, continuing to grow on a compound basis.
Yeah. And it's pretty incredible. Like Blake and I did a webinar that's on the website, nextlevelincome.com/banking, or clicking on the banking link there. And it's wild. Like right now, I can borrow money against my policies at 5.5%. And I'm actually getting 6% on the value in the policy. I'm making 50 basis points. So if I took that same dollar and just, put it into investment, I can actually put it in and get 50 basis points higher, putting it into the policy and borrowing it back out first. There's actually a positive spread currently.
Yeah. And that's a good point too, because depending on company, depending on the policy, et cetera, will determine how the internal loan works.
Yeah.
But there are also banks. You can set up a cash value line of credit at a bank. And in your case, one of the nice things about that is speed of access. So it's a little bit faster getting access to funds.
Yeah.
A second benefit is that you have multiple policies, but you can aggregate them all into a single source of funds there.
Yeah.
And then the third thing is, depending on interest rates, you can create an additional arbitrage, an additional spread in your favor when you compare what you're earning compared to what you're paying interest on the loan. So options. I think that's the biggest thing is that there's flexibility. There are a lot of options that you can, use just depending on conditions.
Yeah, no, it really is incredible. And especially over time, I've seen, and, we work together and, put a plan together to really, have these policies grow and self-fund and just, really build. And now we're looking, Blake, towards, this generational wealth component, which is, you can take the value into those policies that's grown and ultimately the death benefit. And that can turn into basically this cascade event for future generations. What does that look like, for clients or investors that are looking to, not say, hey, like I talked to a financial advisor, I don't know, a year or so ago, and he's like, yeah, my clients don't need that. They have term insurance. They have enough, assets, and they can just spend those down, in retirement. And I said, well, what if they want to leave like a legacy for their family? And he just kind of looked at me and he was like, well, that's not really what we do with our clients. But for people that, have been working, doctors, entrepreneurs, people that have spent, decades of their life, growing their wealth and do want to leave a legacy, for the next one, two, multiple generations. Like how does that play into that, Blake?
Well, one of the things I think is really cool about this tool and using these strategies is I'm assuming a lot of people who are listening to your show, Chris, who are you're interacting with, are trying to grow their investments, right?
Yeah.
They want to grow their wealth. They probably have their own reasons on why they want to do that. But one of the nice parts about life insurance, yes, most of the people come to us saying, hey, how can I maximize the investing that I'm doing? But regardless of whether you want cash value to increase your investment returns or you want death benefit, you're going to get both, right? You're
Yeah.
going to get both regardless of which one is more important to you. So yes, people are talking, and when we're meeting with them, hey, how's your investment flow? How's cash coming in and out of your life? How would this policy interact and benefit you? At the end of the day, a lot of people say, hey, I want the minimum death benefit, minimum death benefit. It's like, okay, well, we're going to set it up that way regardless. But as I mentioned earlier in the show, one of the cool things I get to, continue to have relationships with our clients and meet with them and see how their worlds evolve over years. And as people get older, that death benefit, while they didn't set the policy up for that, that becomes a huge piece to their legacy,
Yeah.
right? It's a way to contractually guarantee if your real estate empire blows up, right? And your Bitcoin goes to zero and everything in the market crashes, no matter what, contractually guaranteed your family's going to get 7 or 8 figures of wealth that's going to be passed on to them tax-free. Now, hopefully that's on top of all the other, things that you've created. I'm not
Yeah.
saying this is the only tool you can use to pass on wealth, but I've even seen it in my own family where people will, the grandparents passed away. They have a whole bunch of assets. They have house, they have, stock market stuff and different type of buckets in terms of how the taxes work. They have real estate, but what's the coolest thing to inherit is a life insurance death benefit, right? Because that's a single tax-free check that can be used either just to give cash to the next generation. It can help with the estate in terms of how we divvying this up. If someone takes the house, well, here's a big bucket of cash that another sibling can get. So it's an incredible wealth building tool and kind of legacy tool for those who are legacy minded. Even if you don't set the policy up necessarily with saying, hey, I want to give my kid, I want to have $10 million of death benefit. A lot of times just by trying to optimize your investment, these policies, you're going to create that type of legacy on top of it.
Yeah, and the neat thing is, if you do this in conjunction with your investments, these policies effectively pay for themselves.
Yeah.
Which is really cool. So it's like you're almost you take the time to set the structure up, and you really get the death benefit as a bonus on top of all this with all the other benefits. And just to share a personal story, I have a very close friend, and he called me out of the blue about 10 years ago and was saying like, hey, like what do you do? And I explained it to him, and lo and behold, he goes to his financial planner, and they set these types of policies up for him. And his wife passed away less than 3 years later, and she was a surgeon in the military. She contracted a very aggressive form of cancer when she was overseas from the burn pits, and they had that pool of capital so he could spend more time with his daughters and devote that. So I think I think that gets lost sometimes in these discussions of, oh, is it worth it? Does it make sense? And the one thing I really it kind of grates on me when I hear financial advisors say, oh, it's not a great investment, and I give them that example and say, well, what's the return on that policy for my friend? It's really high, but it's not really an investment. It's a tool that people use and count on. But Rod, I think, to wrap up, I know you're an entrepreneur, you're a business owner, you use these policies. Maybe you could share a couple ways that, some of your clients have used these policies to really, help, their businesses, either when they're faltering, during, we had Helene here, we had COVID. I relied on my policies both times during those, not just, for investments. What are some pretty interesting or cool examples that you've seen these policies help your clients?
Yeah, it's a great question, and we've been focusing so much on the investment part of it.
Yeah.
But for the same reasons as we like for that as the opportunity fund for our investments.
Yeah.
It's also a great place to store our emergency fund, or at least a good part of it, right? I'm always going to keep some cash close, to hand.
Yeah.
Keep most of my emergency fund in my policy because, again, it's earning that consistent 5+ tax-free return.
Tax-free.
And when I need it,
I don't know if we mentioned that earlier. Yeah.
Yeah. And when I need it, I just go access it and I use it. But if it was my emergency fund from my bank account, I would replenish it as quickly as possible. I'm just using a loan to take that money and use it and then replenish it as quickly as possible there, right? Paying down the loan for that to do that. So probably the most frequent use of that I've seen is just taxes. People get a bigger tax bill than they thought. And it's like, well, where do I have my cash? Oh, great. There it is. I'll take a quick loan and then pay off the loan over the next, 6 months or something.
Yeah.
And, but it really could be anything, right? Yeah. I've seen people using it for weddings, for college, right? For their kids. Mm-hmm. And the idea is, well, I'm going to be setting this money aside for future need. So again, now it all of a sudden fits in a similar category, whether it be an investment, whether it be college, whether it be the wedding, whether it be whatever. I want to give a gift to my kids, when they buy their first house. Yeah. Right. Okay, great. So we have a lot of people who put policies on their kids with their kids as the insured, but the parent is the owner still, right? They're pulling all the strings until they're ready to gift it to their kids. So, maybe I'm going a little further astray than what you had intended.
But I love that too.
That we see all kinds of different ways that people use them in addition to, and then on the investment side, man, we've seen across the board, business owner has any kind of a capital expense, and so they'll use a loan against the policy, buy the thing, whatever they needed, open up an additional location. Like you said, we work with a lot of doctors, dentists, etc. They're buying into the surgical center. They're setting up an additional location for their dental practice, and so they'll use loans against the policy to do that, and then funneling that revenue towards it to pay down the loan. Technically speaking, that's what they're doing, but strategically they're freeing that money up because they're going to go in and use it again in something else later, right?
Yeah. No, and just kind of underscoring what you brought up earlier, Rod, is the immense flexibility that you have with these policies, right? You can use it for so many different things. So as we wrap up here, we've got a ton of great resources on the website at nextlevelincome.com/banking. You can check out the webinar that you and I did there, Blake. And if you're sitting here thinking, well, how would this apply to my specific circumstance? You can set up a call with our team. You can take a look with Blake and I and say, hey, how would this apply to my specific situation? What are some different options that I have, and take a look at? And I'm also available as well. So if you want to say, hey, Chris, how have you actually used this in conjunction with your investments? That's why I got licensed. So I can really help you to optimize your investments with this strategy and really get the benefits of all those. So Blake, Rod, always enjoy having you guys on the show here. We'll be doing a webinar in the next few weeks. So check out the link in the show notes below. You can register for that, and you can hop on and we can answer your questions live as well. Rod, Blake, thank you so much for your time today.
Thanks, Chris.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.